Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for May 17th of 2021. Please see our disclaimer for important information. Well, as we begin our chart pack this week, we revisit our COVID tracker as well as our vaccine tracker, and you can see the trend lines that have been in place for several weeks are continuing with regard to the 7-day moving averages of both daily new positives as well as daily deaths. Now, the daily deaths seem to be holding in there pretty well, and daily new positive cases are going down considerably. Now, we know that we've got about 265 million total doses administered as of May 12th, and you can see the distribution on the lower hand, or the lower part of this particular chart. We've got Johnson & Johnson, which is now being re-administered after a brief pause for some health studies. But clearly you can see that the aggregate number of shots in arms is going up, even though the pace of which seems to be slowing down just a little bit now as we get close to 50% of the population being vaccinated. Here's our high frequency data. Again, we're looking at kind of the longer term trend lines. Obviously, the year over year comparisons on a lot of these things are still fairly negative, but the gap is closing. Now, the one bright spot you can see here on rail car traffic, we know that goods production, goods demand, durable goods purchases, all of those numbers are looking really, really positive. And that's probably, from this week's point of view, kind of the headline number. TSA checkpoint data continues to evolve. We've had a little bit of a stepping back in terms of hotel occupancy and some of those things, but as I've kind of articulated kind of time after time here over the last few months, I don't get caught up in the short-term numbers. But looking at this data, it really looks on the whole positive to me. You look at retail. Weekly retail sales trending higher. Obviously, the job market continues to evolve and get better. Continuing claims continue to go down. In fact, we've got a labor supply choke point right now in a lot of industries and a lot of businesses. So here's a couple of key elements of that high frequency number, and I did mention staffing and labor market. You can see the numbers at the upper part of this chart, that heavy blue line is 2021. You can see that number looks a lot like 2019, which is really healthy. So from a staffing point of view, from a labor point of view, we're looking a lot better. Now, we seem to have anniversaried all the issues that we saw last year. Labor market's getting tight again, even though that overall unemployment figure is not quite back down to where it was. But it may get there actually a little bit sooner. Now, there is some friction in the labor market because of the $300 unemployment benefit stipend that people are getting. So kind of almost a disincentive to get back in the workforce. That's at the really low end numbers where people getting the stipend accounts for more income than they would receive if they were employed, and so that's creating some friction at the lower end of the skilled labor spectrum as well as the unskilled labor. But that number is improving, and we're going to punch through that at some point. We're just working through a lot of this frictional issue right now. So you look at initial jobless claims, continues to trend down even from the end of last year. Numbers looking good, even though the aggregate number is well above where we saw in 2019. Not a problem there. Continuing claims. This is the number that means perhaps a little bit more to me, just because it shows you the amount of ongoing claims, extended claims for unemployment insurance, and you can see that number continues to trend down as well. I think very positive from that perspective. As we continue to kind of think about the labor market, on the left-hand side, you've got U.S. job openings. So as the economy is re-emerging from the pandemic and businesses are reopening and they're scaling up, you can see the job opening number is really strong. And on the right-hand side, you've got data from the National Federation of Independent Business, NFIB, that shows you that the share of small businesses with positions that they're not able to fill right now is taking a spike up. And that number is kind of around 45% right now. And that's a meaningful number. So this is an economy that is kind of like rose from the depths. It's kind of stuck its head above the waterline. It's choking for air. It's trying to, breathe new life here. And we have this labor choke point. And frankly, our economic data overall, the GDP number would be even stronger if we didn't have these labor choke points right now. But this is a sign of an economy that has some growth left to it, because there are businesses that are seeking to expand, but they just don't have the opportunity to fill those positions right now. So, and these are some of the reasons come to us by Alignable that folks are citing, for why they can't find people. Now, the $300 supplemental employment benefit is something I've already mentioned. So that's 38% of the respondents talking about that. Stimulus checks, that was kind of like multiple shots in the arm, but we're not going to see that again. That's 24%. Workers seeking higher paying professions. Now, this is something that I think will be sticky because, if anything, the pandemic showed that we could conduct our economy in a slightly different way than we were all used to prior to the pandemic. And I think, workers that were in a workplace that commuted to a job, might actually be thinking differently going forward about perhaps finding a job that doesn't require them to commute and so on and so forth. So I think that purple line there, workers seeking higher paying professions, that's going to be a stickier number because I think people are going to be looking at job openings and job opportunities in a completely different light. And I think obviously the fear of contracting COVID at work is going down. Young parents can't afford daycare. That's an ever-present issue. But if you're out of work or whatnot, or you're stuck and your employer can't let you back on the job site because of COVID, obviously that was an issue. That number should go down a little bit as well. All right, well, so we'll continue on this thread of small businesses. Now, the Small Business Optimism Index, again, I'm really not even going to reference what happened last year because we all know the circumstances. We all know that the chart looks weak when you look at it from the first quarter of 2020. So we've recovered from that. Now, where are we now relative to where we were? Now, the general business conditions, which is on the bottom, it's still pretty low. It's pretty interesting that that we're seeing a rebound in overall small business optimism, at least as defined by this index from the National Federation of Independent Business. But we're not back up to where we'd like to see it. And I think some of this has to do with the labor choke point issue, which we just talked about. Some of it deals with the fact that not all economies are open, so you get kind of this divergence in survey results from one geographic location that may be more open versus another geographic location that may be still a little bit more closed. But by and large, all of these regions are beginning to open up now with the vaccination trends that we're seeing. So, the hope is that we'll continue to see this, and we'll continue to see pricing power, which I'm about to show you, which if small business gains pricing power in the market, which is obviously going to help their margins, help their sales margins and profitability ultimately, then I think you'll see this optimism number begin to pick up. Well, now let's talk about those price trends. So we know that there's inflation in the pipeline, and we've got several charts on inflation that I'm going to show you in just a second. But this is specifically index-related pricing data from small business. So we've got a lot of information on this particular chart. On the left-hand side, we've got two charts. One of them at the top relates to small business prices. Now, this is the survey respondents saying that we're raising prices. And you can see that number is really spiking. I mean, really spiking. I mean, we haven't seen index levels like this in a very long time. So again, this is the ability for small businesses to go out and raise prices, or at least not their ability, but their intention to. So they're definitely doing that to offset some of these input costs. That's raising the cost of goods, cost of services out there among small businesses. So that's obviously going to feed ultimately into inflation. Now, on the bottom side, we have the intentions over the next 3 months, and you can see that number is really spiking as well. So there's a lot of confidence in the channel for small business now to be able to raise prices, and notwithstanding the fact that many of them are raising prices right now. And now, if you look over at the right-hand side, this is kind of an interesting overlay of core consumer price index and expectations moving forward, which is that dotted line that's extending off of that kind of that yellow line. And then superimposed on that is the red line for small business, this notion of small business raising prices, basically the chart on the upper left, which is superimposed on this. And you can see that there is a decent relationship here. And so, again, this whole notion of prices going up and the consumer price index number that we saw last week was much higher than expected, kind of really blew people out of the water. That if you superimpose these two things, you can say, listen, that makes a lot of sense, because you look at that red line and it's really spiking higher. That's going to send your core CPI higher and dovetail. And it's going to continue to meander higher. Now the big question is, does inflation go up, crest, and then roll over and kind of set at a higher point than we've seen it? That could very well be the case. And we've got some interesting charts that follow here that kind of talk about that. All right, well, here is the consumer price index year over year, as well as the core consumer price index down below. And that core, remember, excludes food and energy, which can be quite volatile. And you can see directionally they're both moving in the same way. Now, the latest print, again, this is a huge surprise to the market. We were expecting a pretty decent spike in inflation, and it was higher than expected. So survey was 3.6% annualized inflation. We got 4.2. And even if you strip out the food and energy components, whereas the market expected about 2.3, we got 3%. So again, this is above the Fed's 2% target, at which it said it wanted to maintain price stability at, or at least price inflation stability at. But we had a greater realization in inflation than we thought we were. Now, again, this is leading to a lot of speculation. You'll see this later. I've got a chart on the break-even rate for fixed income. You can see that those numbers are going higher. Expectations are going higher. There's a lot of, I guess, groupthink now that's been building. Now, we've been talking about inflation building in the pipeline for months. But I'd say really over the last 30 days have we really seen this begun to get priced into the market. And I think that's one reason why you've seen a little bit more volatility in the stock market as of late. So this comes to us by way of the Dallas Fed. And this is essentially another iteration of what you looked at, but it's a 12-month percentage change. It's kind of a rolling number. So you look at this number from the pandemic period. Obviously, there was a trough. If you exclude the volatile food and energy components, you can see how that red line is actually a bit more smooth, and it's not as, the valleys aren't as deep and the peaks aren't as high. You can see how that is just an inherently less volatile type trend. But nevertheless, you see, what has been going on lately. We've had low inflation that kind of was sticky, and then all of a sudden, basically in February, we started to see a lot of channel inflation build. Now, what the Fed did here is they said, all right, we're going to smooth this out. And this is kind of the trimmed mean, if you will. And so they did kind of a line of best fit from, the pre-pandemic era to where we are now, and just say, what is the average of this? So this confirms everything that we've been talking about, basically, that we're seeing higher inflation. basically these dotted lines. If you look at the blue dotted line, this is the headline average, and the average is 2.6% inflation trend, basically over the last 14 months. And we know it's been higher, obviously been higher here recently. And if you go to the core side and you strip out food and energy, it's about 2.2. Again, these are both numbers that are above the Fed's 2% target. And so what this is doing is it's causing, some industry pundits, some analysts out there to begin to speculate that the Fed might raise interest rates sooner than they've articulated. Now, we're not expecting, frankly, much of a move in the Fed, but it would not surprise me to hear the Fed, if we see some continuation of these higher spiked inflation numbers, like these 3%, 4% numbers annualized in inflation over the next several months, I'm absolutely positive you'll begin to hear rhetoric of the Federal Reserve begin to discuss raising interest rates perhaps as soon as the first quarter of next year. Again, they're not going to respond at the snap of a finger. They're not going to overreact. I think there's clearly a very strong intention to maintain low interest rates to help boost this economy and more so really boost the labor market across all socioeconomic layers. That's been a big priority of Fed Chairman Powell. So these are inflation expectations, and this actually comes to us by way of the Federal Reserve Bank of New York. So again, the expectations are building based on the data that we've seen. And this is important because, if you look at that number rising 3.25 over 1 year, 3-year number is important. That's going to 3% by this survey alone. So if you look out over several years and you assume that the 3-year you assume that the inflation rate 3 years henceforth is going to look like about 3%, then you have to feel confident that the interest rate curve is going to move higher. The Fed's going to raise interest rates. This is going to translate what you see here into higher 10-year yields that may not have fully manifested into the rate structure yet, just because short-term rates are so low. And the Fed has said they're going to remain low. So I guess the takeaway from this chart is expectations drive longer term rates. And you can see here that those expectations are well embedded. There's inflation on the horizon. Even if it does crest near term and roll over a little bit, there's a really strong expectation that those inflation numbers are going to be higher henceforth, looking out into the next 2 to 3 years. And that gives me a lot of comfort that we're going to see more normalization in the rate curve. 10-year rates are apt to move up, perhaps in the next 2 years, another 2 full percentage points, which would be a lot closer to normal. That does help savers. It doesn't help borrowers, and it probably take a little steam off and froth off the real estate market that we've seen now. But it's healthy. It's a symptom of a growing and expanding economy. Now, this is something I thought was really interesting, again, related to inflation. So you saw that in 2020 with the pandemic, inflation rolled over. And it's been battling back, and you can see the spike here in 2021. Again, if you strip away all the base effects and all the year-over-year comparisons, what this really tells you is that the core consumer price index is basically only slightly higher than the trend line that was established, that was well established well before the pandemic. So we look back in 2018, and I've even looked at an iteration of this time series that went back to like 2012. And so, I mean, it's a fairly predictable line. And again, the rate of change has been fairly muted, right? But the directional change has been extremely consistent in this upward sloping environment. But you can see the impact of the pandemic on inflation and how we battled back. Really, the net of all of the activity over the last 14 months puts us essentially right at the trend line that we were on anyway. The next, I guess, peeling the onion layer back here and looking at inflation in a different light, what's really interesting is that if you break apart goods inflation versus service inflation, you get two different reads. Now they're both moving higher, and so that much is consistent between the two. But what's not consistent is the fact that the rate of change on goods inflation has really moved a lot faster. So if you kind of bifurcate, if you will, what's going on in inflation, most of that impetus here lately has come from goods, even though service inflation is beginning to creep into the picture. But service inflation is still below its trend line pre-pandemic. Goods inflation has really taken off, and we kind of see that anyway, right? Because we see a commodity price inflation, steel prices are going up, a lot of industrial metals prices are going up, and we know the Baltic Dry Index is just going through the roof. So, I mean, there's a lot of things that we know are driving goods inflation. But when you really think about the impact on the economy, and this is not me kind of waxing, a lot of caution here, but it's just saying that the service part of our economy is much more significant than the goods part of our economy. And the fact that we're beginning to see some momentum in services inflation gives me more comfort in forecasting that higher overall level of inflation, because these numbers are coming up. Now, goods inflation, I'm quite certain once some of these supply chain choke points work themselves out, they'll fall back to kind of a trend line. But I do think service inflation is going to continue to rise here. All right, well, now looking at the various components of inflation, this is really interesting because these are areas that really lagged last year. Now you've got travel and leisure on the left-hand side. Look at those things and the numbers, CPI percent change month over month. We saw used cars 10%, trucks 10%, airfares 10%, hotels, motels, and public transportation. All of those prices are going up, and they're actually having a meaningful influence on CPI. So when you think about inflation, it's not just the commodity basket. It's not just fuel prices. It's not just wheat, corn, and some of the soft agricultural commodities. It's stuff like this that's beginning to creep back up. And areas that were hardest hit in terms of pricing power are now gaining that pricing power back. You can see that on the right-hand side, and particularly with regard to used vehicles. And that's been very pronounced. With the supply chain constraints related to semiconductors, we know that new car builds have gone down considerably, and as a result, that's created an increased demand for used cars, and used car prices have actually gone through the roof. So you can see kind of interesting inputs into the inflation basket as of late. Now, switching gears here, I want to talk a little bit about state and federal receipts, and this chart here is really telling. We've had a lot of debate at the congressional level about follow-on stimulus. The latest legislation that was passed was going to benefit state and local governments. This chart, again, I'm not speaking from a political standpoint, but I'm just looking at it objectively that, as much as we feared the ability for state and local governments to fund their operations and to remain fiscally sound this time last year, the opposite has actually been the case. So we've recovered so quickly, and incomes and whatnot, despite the dislocations in our economy, despite the fact we've got higher unemployment, et cetera. State and federal, state, local, and federal receipts have gone up tremendously. In fact, you could argue that they're punching through prior trend lines, especially at the state and local level. This is a phenomenal development, and I think this speaks very highly to kind of this groundswell of opinion that state and local governments don't need additional stimulus. They already have it. This chart is fairly strong in terms of its visual power in making that argument. You can see state and local revenue is up 7% year over year in the first quarter, and federal receipts were up 11%. This is something I've been talking about for quite a while. So you've got SP 500 companies that are holding a lot of cash. Their balance sheets are really strong. Even though there's a lot of debt, that debt is very low interest rate. And so it's not curbing the ability for a lot of companies to generate outstanding cash flow. So again, interest rate costs are low. They're still able to drop a lot of money to the bottom line because business is picking up, global expansion, so on and so forth. So cash and cash equivalents on the balance sheets of S&P 500 companies, you can see on the left-hand side, have really taken a spike up. I mean, this is a very interesting circumstance. And, you know, we could see this developing late last year. And so the hypothesis was at that time that we're going to see more dividends being paid, dividend increases for companies that had curbed or basically ceased paying a dividend. That is absolutely played out. And now what we're seeing also is those same companies not only paying more back to their shareholders in actual cash distributions, but they're returning cash to shareholders in the sense of share repurchase. So you can see here that the repurchase authorizations through the beginning of May are really fantastic. In fact, these two charts come to us from an article in the Wall Street Journal from last week. And so basically, if you look over the last 10 years, companies have repurchased a total of $5 trillion of stock. And that has actually had a pretty profound impact on overall investment returns from the equity standpoint. You can see we're getting back and actually surpassing levels that we had earlier in the last decade. So, and kind of to wit, you know, looking at the companies that have been able to deploy this cash flow, either paying dividends, and in this particular case, companies that have announced buybacks and that are executing on buyback and repurchase programs, you can see that return differential is tremendous. It's over 10 percentage points higher year to date than the overall S&P 500. So what does this mean? It just means that companies that are deploying cash, that are paying dividends, companies that are buying back their stock are performing much better than the overall index. And this is a big reason why we've got dividend growth in our investment basket. We've got high quality capital strength exposure on the equity side. These are companies that absolutely have the wherewithal to do this. So this is a very interesting development. So I wanted to draw your attention to something I found in a piece from JP Morgan. And this is basically, looking at the tech bubble and the global financial crisis and kind of taking stock of not just how far we fell on the large cap and small cap side, but how much we've gained back. And so what's interesting here, the clear takeaway here is that when you see a trough, the small caps typically react stronger and more boldly than large caps. And then, you see in the tech bubble, large caps dropped almost 50%, small caps dropped 43%, but the rebound 12 months henceforth from the trough of the sell-off was that small caps reacted, much more strongly, 61.5% versus 35.3%. You can see a similar trend line back in the global financial crisis when stocks were down 55 to 60%, but you could see 12 months forward from that trough that small caps reacted very strongly, up 100%. And, in COVID, you can see the small caps actually took a bigger hit than large caps did. And it was a painful drop in a very short period of time, but you can see the robust reaction to that. So this is very emblematic of what's going on with small caps. And I think there's a lot of staying power because small cap margins were really, really tight heading into the pandemic. And as we see the global economy kind of re-emerging from this and a new economic cycle developing, I think I would be very optimistic at the ability for small caps to continue to run. Now, in this slide, we're kind of looking at the value versus growth conundrum, and we know that growth has outpaced value for many years now. We know if you take a long time frame, however, that value tends to outperform growth. And in this case, we're seeing the byproduct of this new economic cycle developing post-pandemic. And really the divergence took place in March. And we could really see that really over the last 2 to 2.5 months now that value has kind of taken the lead over growth. And that differential seems to be expanding as we would expect in a normal cyclical expansion, that the cyclically exposed companies, which are typically value stocks, these are kind of stodgy firms that have kind of relatively stable cash flow. They're not sexy, they're not technology, but they're cyclically exposed. So when you have a cycle expansion, these are the companies that outperform: industrials, financials, in many cases healthcare, and you're seeing the outperformance by value right now. And this is a trend that even 2 months ago we felt was going to have some staying power, and we still feel that way. So you can see us adding more kind of value components to our equity profile, as well as some of these other capital strength and small cap, et cetera, components. But you can clearly see the divergence here, and I think there's some staying power to that. This is the 10-year break-even rate. So this is kind of getting back to inflation just for a second, but it's really more focusing on what's going on in the fixed income markets. And you'll see this in the next couple of slides, that this inflation expectation is really beginning to manifest itself in the fixed income markets. And I think this trend is going to continue. So if you look at the fixed income markets, longer dated maturities, and in this case we're looking at the 10-year break-even rate, the longer dated maturities have the most price risk. So right now, as we're on the precipice of observed inflation, increased inflation expectations over the next year or two, that you're apt to see that yield curve move higher. As I mentioned a few minutes ago, the 10-year yield, I'd look for it to move perhaps another 1 to 2 full percentage points in the next 24 months. It would not surprise me. And so you would not want to be in 30-year, basically 30-year bonds at this point, because those are going to be the most adversely impacted. And you can see here the inflation break-even rate is moving much higher, about 2.5%. So here's that point on the 30-year fixed income. So, I mean, when we had that inflation number, the CPI number came in at 4%, much higher than expectations. You can see what it did to the long bond, and it spiked. We haven't seen 2.4 ish percent on the 30-year government bond in quite a while, and you could see how quickly it happened. And so this is a huge price disruption that bondholders, with a long maturity or long duration, rather, if you're technically savvy, you use duration, because there's some math behind that, but but you could use average duration as kind of a very rough proxy. But those longer maturity bonds are really getting hit hard right now. And here's an interesting development. With interest rates moving higher, we're not seeing a response from junk bonds. This is the Credit Suisse High Yield CCC Index. These are some of the highest risk bonds out there. These are issuers that have a high risk of default, high risk of bankruptcy, of financial distress, whatever you want to call it. These are the highest risk bonds, and you can see that the yields continue to go down, and they're really undisturbed by this whole notion of inflation going on in the background. Now, you would expect empirically that inflation is going to move all rates higher, but in this case, it's clear that it's not pushing the high yield index down. So what are the read-throughs on this? the read-through clearly is that we're in an economic expansion, that credit quality is only going to continue to improve, even for these high-risk issuers. And so, and the fact that there's a lot of people out there that are looking for yield in a low-yield environment. Now, I do think this is going to turn around when the Fed decides to start raising interest rates, because eventually there's going to be competition for yield in treasuries, but there isn't right now because interest rates are basically zero at the front end. But this is a very interesting dynamic. I would not have expected this with the inflation that we've seen, but this is a powerful statement as to the perceived strength of the current economic cycle. This is something I thought was interesting in the reading from Bloomberg, and we know that this trend has taken place over a number of years. Again, the pandemic aside, we know that there have been kind of this general shift away from core equities, if you will, and into fixed income. And this is corporate pension money. So this is pension money. This is long duration assets that have a return objective. They've got to return a certain amount to meet distributions that are anticipated. That again, actuarial assumptions that go into all of that. But what's interesting here is that even now, if you'd told me like 2015, 2020, when we were still seeing interest rates move lower and a lot of the return from bonds still coming from capital appreciation, why you would see more pension move away from equity into fixed income. But in 2020, we see that kind of leveling off, and what's really going to be interesting is what that number looks like in 2021, given the fact that I really do feel like we have exited the last rate cycle and we're entering a new rate cycle of increasing rates over time. And you could see this trend really reverse itself in kind of a hard way as pensions move back into equities and risk assets. And this is something that kind of goes back to the inflation basket. Now, gasoline prices do go into the CPI, the headline CPI, and you can see what's happened there. As we exited the year, we were less than $2.20 a gallon overall, and now we're almost $3 a gallon. So you look at that in percentage terms, that's basically a 30% jump, which is really meaningful on pocketbooks for people that are choosing to drive more now. So again, just one more inflation data point to kind of remind us of what the backdrop looks like. And it wouldn't be complete if we didn't look at the dollar. So with inflation expectations moving higher, we already saw what's happening to the 30-year bond. We know what's happening to the 10-year bond. It's beginning to get new strength. Those interest rates moving higher on the heels of inflation is actually giving strength to the dollar, which frankly I didn't think we would have as much of. But again, I didn't expect us to have as much inflation 3 months ago than we're experiencing right now. So as it were, the dollar is strengthening, which does hurt to some degree our exports. It's not catastrophic. Again, we saw a lot of dollar weakening in the last year, which is fine. It did help our exports at a time where we needed it. Now that kind of is reversing course. But we've, if you look at this time series on this chart, it's obviously, essentially a month. And so I wouldn't get too carried away with what this chart looks like, but suffice it to say that when the inflation numbers came out, it really started this reversal in the dollar. So it's going to be very interesting to see how much the dollar continues to strengthen from here. And close out here with a couple of interesting charts. Now, we know that lumber prices have gone up with all the other commodity baskets. And construction costs have gone up as well. And so what's interesting here, in 2020, $50,000 of lumber would have built you just over 10 single-family houses of some average size. And now, with lumber trading at about $1,500 a board foot, you can only build basically a little bit more than two. And it's just kind of in relative terms. And I've heard this from at least two different developers. One, a very strong and very active developer of residential dwellings here in the Central Texas area, said this very same thing. I mean, it's creating a huge crunch on margins and pushing prices higher. And this is just profound. I saw this chart and it just made me step back and kind of breathe deeply for a second. Well, in the wake of the colonial pipeline, I thought it'd be apt to close on this, that this is something that is both political and it's an impact to the cost of business too. You can see the rise in the global cost of ransomware in billions of dollars, and this number is only going to continue to go up. It is really a call to action on the part of our government to get out in front of this, because I think this is kind of the new that we need to be worried about over the next probably 5 to 7 years. That the cost of ransom, basically the ransom cost rather of electronic warfare by people that want to steal information, that want to extort money from operating business, is only going to go up. And I think it's going to penetrate not just the folks like Disney and Sony and people like that where we've had well documented breaches, but it's going to penetrate lower into the small business sector. That's all I got today. Hope you've enjoyed the chart pack for this week. On behalf of all my colleagues at BKA Wealth Consulting, hope you have a productive week, a safe week. Look forward to seeing you again soon.